Hello everyone, welcome to another edition of ACY Economics in lockdown in Sydney, Australia, where the sun is out and it's a beautiful day. Not so nice for a lot of people still in lockdown, but our thoughts go to them, and we hope that everyone will have less restrictions sooner rather than later. The problem is that it's not looking like that will be the case, and whilst we've talked about this at length before, but it just remains the dominant feature of the Australian economy at the moment, how we all want to be out of lockdown, but if we come out too quickly, we could well end up back in lockdown again, and that would be just devastating for everyone, especially the economy. The key point I've been making all along is that we are definitely having a recession in Q3, Q4, and it's definitely going to be a protracted, slow rebound. Initial spike in the data, falls back a little bit, then a long, steady progression in terms of economic recovery. Nothing at all like we saw on the previous occasion. So equity markets are still overly enthusiastic, overly optimistic, and there is a lot of downside for the market, which could be coming very soon. I tend to watch the Nasdaq. If the Nasdaq were to move back under 15,550, that would suggest that across the board US equities were beginning to weaken. And the one thing the Australian market has been hanging on to is this idea that stocks go up no matter what. But if US stocks begin to give up their gains, it's going to be very difficult for the Australian market to hang on, because our situation in Australia is far worse than the economic situation in the US. We would have one of the lowest performing economies in the world at this point in time. So if equities begin to price that in, it is going to be a little bit of a free-for-all for a period of time to the downside. In terms of currencies, we are getting that US dollar stabilization. We are getting the commencement of a US dollar recovery that I was talking about. And I think that will be a steady process, a little bit of choppy consolidation, but US dollar higher overall. A lot of people are talking about bond yields moving higher. That's because governments all around the world, particularly in the US, but all around the world, are really dumping bonds into the market to try and pay for all those stimulus measures and all the expense of Delta. Those stimulus measures and expenses are ongoing, particularly in the health sector. So that's certainly weighing on the US bond market, and it will do for some time. We are likely to see higher inflation, higher bond yields, but still solid, low, near zero interest rates from the Fed. Yet it will be a US dollar bullish story because it's still a safe haven sort of perspective that people are sort of applying to the US dollar. And as Delta gets worse around the world, as unfortunately it looks to be doing, we're going to see more safe haven buying. Which brings me, of course, to gold. You know I'm bullish gold, and gold just had an incredibly sharp fall. Gold can do that. I did say, you know, black gold and shiny gold, they're both going to be volatile. Overall, though, black gold is headed lower and shiny gold is headed higher. And I'm sticking to that view, and it's kind of a little bit a bit of a cute description, but I think if you can remember that, it should carry some benefit. The Aussie dollar, obviously with the US dollar beginning to strengthen again, is getting sold off, and a lot of people are caught long the Australian dollar at this point in time. So the Australian dollar, like Australian stocks, is particularly vulnerable to any sort of broad-based global pressure for it to weaken. It will weaken more dramatically, i.e. if the US dollar is going to strengthen, the Australian dollar is really going to hurt. If US equities are going to weaken, the Australian equity market is really going to hurt. They're the things to watch for at the moment. On the economic front, we saw a positive Japan GDP number, but that number is still, the Japanese economy still has not recovered from the pandemic. It's still well down on where it was pre-COVID. So still a lot of work to do there, and a little bit choppy going forward. The market has liked some of the recent announcements in Japan, so there could be an opportunity there that those Japanese equity markets are becoming a little bit overheated just on a short term. On a long term, they're probably a good buy. Elsewhere in the world, the data in the US really is still very negative. And I think what we're seeing in the US is a very late realization by the economics community there that Delta isn't just a risk, it's actually having a very profound impact on economic performance and will continue to do so. And that's something also that in Australia people haven't really fully awakened to. We still have our RBA governor saying we're going to have this sharp economic rebound. And of course we're not, because the conditions aren't the same as they were before the previous economic rebound. So why would you get something that happened in different circumstances happening this time around when everyone's already bought what they want? There isn't JobKeeper, there isn't access to super, there's only targeted support, not blanket support. And it's a very different environment, and people are a lot more jaded, and a lot more small and medium-sized businesses are closing down permanently. This is a very, very difficult time for Australia, more difficult than the economic data has managed to show up yet, but that will happen with time, unfortunately. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities.